The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-873-7618. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. We're going to take a look at the German DAX and also the FTSE like we usually do. As you can see, they are in the midst of a correction opposed to what we're seeing here in the stock market in the United States, which will be helped by the NASDAQ today because of the earnings of Apple and Amazon and Facebook and a little bit of Google, I guess, but these others have been very, very strong. As a matter of fact, the market, from a technical standpoint, given all this bullish news, to me, does not look that bullish, folks. And if you're in the Dow Jones Industrial Average, you're not involved in this up move. So be very, very careful if you happen to be long these Dow stocks because they're being masked. The weakness that is there is being masked by what's going on in the NASDAQ and S&P. And even the S&P is not acting that bullish. That number that we hit last night at 3273 was a 1.27 expansion, and we actually were down on the day sometime in the middle of the night. I don't know exactly. We dropped about 30 handles, and now we've rallied back into that level. So just be careful up in here. As always, it's best to use your common sense. Let's take a quick look at some of the things that we've been watching this week that are actually acting pretty good. Here is the Treasury bond market. You'll notice where we have that strong resistance, folks. To be short the gold, Mr. Z, and the reason why I'm short the gold, I'll tell you folks, because I'm a big believer in the ABCD here, and if we take a look at this ABCD pattern here in the December gold since March the 23rd, when we had that big bottom, that number is 1997, and we hit 2005 on a fast tick, folks. On my charts, there was not there for it was there for less than a minute above 2000. That's how quickly it went up and came down. And frankly, if you the open interest yesterday with that move we had in the gold, really strong move in gold, and again some more last night. But the last night stuff hasn't come in yet. But we had a big drop in open interest yesterday, folks. 11,000 contracts left the market, when it was above that 1990 level. So that's not good action. if you're looking at open interest, we've been saying this open interest has been increasing pretty good, but frankly, it's not doing that now as we get into the high ground. And this big ABCD, I believe in the ABCD patterns, and that's the main thing. By the way, our guest today will be Bill Meridian of Cycles Research, Vienna, Austria. Always glad to hear what Bill has to talk about, and he's been very bullish gold for a long time, talking about the positive area of July and August. So we'll see a look at that. Okay, let's move on here to the next one that we want to talk about, and let's get up to. I covered the Treasury bonds. I covered the gold. I want to also show you that we, with the gold making new highs last night, I wanted to show you what was happening in the silver. The silver was making a 135 pattern. You can see over the last 3 days, we've had two lower highs. They come right in at the fib numbers, and that is a 135 pattern, folks. So whether that divergence means anything or not, I don't know, but we're just looking at seeing how the market reacts to these things, and that's really what you're doing when you're doing technical analysis, is you're looking at market feedback. So that's another thing to pay close attention to, I would think. By the way, I had a real interesting call from my daughter yesterday. She is a clinical psychologist over in San Luis Obispo, and she's got a very thriving practice. And she got a phone call from somebody who was driving through San Luis Obispo and was looking for me. And she said, the person called up and said, where is Larry? And he told me I was over here and stuff. And she asked who she was, and she says, yes, I'm his daughter. And she said, well, tell your dad that he changed my life 25 years ago when I came down to Pismo Beach, and I just wanted to come by and say hello. So and it made me feel pretty good. So anyway, that's really good. I remember the fellow too, and he's a little younger than me, but he's been trading his whole the last 30 years, and he's done quite well, and his boy is trading with him. So that was a fun thing to take a look at. So I did mention that we will have Bill Meridian on. I forgot to bring that to your attention when we first started the show, but that's one of the things that we want to be looking at. I'm going to do a little bit different segment when we come up to the next segment here, because I believe that I want to talk a little bit about some of these patterns that we have going on, but I wanted to share you this one. Here's one that is the British pound. You'll be able to see this big three-drive pattern that we're having here in the British pound versus U.S. dollar. That's one of the ones that we're going to be looking at from the short side. And also, folks, that Japanese yen, if you remember from those of you that get the newsletter, when we talk about some of the, hold on one second, please, and I'll get it up here for you. And at least I hope I will. Here it is. Yep, here we are. We have completed, I'll just get this up here. We have completed this pattern here in the Japanese yen. We've got it up here to this level here, above this 95.40 level. So that's another one that's looking really interesting. But the pound has some really good patterns up in here, as does the euro, because the euro is the exact opposite of what's happening in the U.S. dollar. But that U.S. dollar hit the exact tick, folks. I mean, you can't make that stuff up. And, I don't know that's a big index, too. So I think it's very important that we've been waiting for it for a long time, and we're going to see whether it's going to happen. We'll be right back. 877-927-6648.
If you're not currently using the TAS Profile Scanner when looking at setting up your trading opportunities, then your arsenal is short a mighty weapon. The TAS Profile Scanner is a standalone piece of software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Headed by Steve Dahl, TAS understands that in today's technological world, the use of top-flight software applications and technical analysis expertise is essential to successful trading in today's market. You also gain access to the webinar that Steve Dahl and Tom O'Brien just hosted, The Best Way to Use the TAS Profile Scanner Scanner to Profit. This webinar archive is available for all subscribers immediately upon signing up. All new subscriptions also come with a 30-day money-back guarantee, so you have nothing to risk. Start your subscription by visiting the front page of TFNN.com today, and you'll find the TAS Profile Scanner under the Services tab. Sign up today. Are you in the market for buying or selling real estate in the Bay Area, including the surrounding St. Petersburg, Tampa, and Clearwater markets? Tiger Real Estate LLC is a firm that has extensive experience in the Tampa Bay area. Whether you're looking to sell your current property for maximum value, or you're in the market for a second home or investment property, Tiger Realty has the experience across all areas of real estate in the Tampa Bay area to help buyers and sellers make the most informed decisions across all price levels. From the price you should be paying per square foot in certain up-and-coming areas to the type of cash flow investment properties are capable of creating, Tiger Real Estate can help you make the best decision when it comes to all areas of the market. Before you make one of the biggest decisions of your financial future, call Tiger Real Estate LLC today at 727-329-8322 or email us at tiger@tfnn.com. That's 727-329-8322. Call us today.
Many of our new listeners have heard about The Tiger's Den. The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of the TFNN shows, plus see all of the charts as they happen live and have access to archives of all of those charts. You can test drive The Tiger's Den absolutely free for 30 days and greatly enrich your knowledge of these markets and how to make your money work for you. Details on The Tiger's Den are on the front page of TFNN.com.
TFNN has launched our brand new website. You can still visit us at the same TFNN.com URL, but when you do, you'll see a new and improved homepage with a much simpler navigation, whether you're watching Tiger TV live in high definition or just accessing your newsletter subscriptions. We even have new pricing in 6 months and yearly options. Check out the new TFNN.com now and experience all the upgrades. TFNN.com, educating investors.
Call now, toll free at 1-877-927-6648. Internationally at 727-873-7618.
Okay, folks, I've posted a chart here from the this Floor Traders Handbook that we published here this year. I just wanted to show you what patterns are, folks, and what they really mean. When you read the book by Dr. Andrew Lowe, the Non-Random Walk Down Wall Street, he looks at all of these patterns mathematically, and they have special formulas to determine whether the pattern is correct or not, and what the probabilities are, and what the expectations are. And all of these, we're talking about not the ABCDs, but he's talking about double tops, triple tops, head and shoulders patterns, rounding bottoms, those kinds of things. But they don't go into the ABCD pattern, which to me is the most basic of all patterns, because that's what the market does, is it goes up, down, or sideways. And what you're trying to do is to find whether you're in that situation. Now, the one thing that I'd like to bring to your attention, I've talked about this in the books that I write, but if you'll notice at point C down there where it says entry at 0.618, folks, that gives you so much information that it's just truly unbelievable. When I first started to do this stuff many, many years ago, and then when I went to the floor of the Merc back in 82, I was armed with this pattern and some Fibonacci numbers. That's what I knew. I knew that I could trade against anybody against those numbers because I'd been doing it at Drexel, but I wanted to see on the floor if these stops that were there in the market were fair, and they certainly were. So with that, I knew that I was going to be okay because I knew these charts were going to be coming to our computers like we have them now for the past, 35 years, and they're getting more and more complicated, of course. But if you keep it as simple as possible, you can do this. Now, with the handbook, what we tried to do was to show that the probabilities on how these things work is what's really important, because when you're at point C, that's one of the most key things that you have in the pattern, because you already have information between point A and B, whether that's a run in Apple, like we're going from 399 up to 420 last night, 422 or something, and it splits 4 for 1, whatever that happens to be. But when that point comes down to point C. How it comes out of point C is the greatest amount of information you could possibly ask for. If you come out of point C very, very quietly and don't do very much over the first 7 or 8 bars, that's telling you that there's something probably not right. But on the other hand, if you get to point C and the market explodes out of there, either with a gap or a really wide-ranging bar, you can almost be assured, and with a better than 95% probability, that AB equals CD leg is not going to be 1-to-1. It's going to be 1.27 or 1.618, and sometimes 12.8 or something, because they can go crazy. So that's why that point C is so very, very important. So what I tried to do with this handbook was to prove to you mathematically that this is what happens. We used it with the euro, of course, because that's the most actively traded thing in the world and gives you the most data to look at. But if you will just follow those patterns and watch what happens at point C, because that's very, very important. And also, just like we're looking at in the U.S. dollar index tonight, right now at 92.51, that 1.618 number is just absolutely important, because that's your last point of resistance or support. And once you go through that, it's the big unknown, so you don't want to stand inside of that. That's why, this weekend is going to be so important for the U.S. dollar. The fact that the U.S. dollar went above to $2,000 an ounce just at the same time we were making the 1.618 expansion in the U.S. dollar index at 92.51, that means something, because, folks, I know what these little bars mean. The rest of the stuff I have a difficult time with. I really do. I don't know if it's old age or what, but I don't feel old. But I don't grasp the real heavy calculus and stuff like that, because this is simpler. It's simpler than that. I mean, at least in my opinion, is you don't need a whole lot of information. You're looking for market feedback and how that it's looking at. And what market feedback is telling me today, by looking at the pre-market and everything, we have these, we've got Apple, splitting 4 for 1. And, we've got Amazon really strong, and you've got, Apple's going nuts. Amazon's really strong. Facebook is really strong. And when you got these guys at they're going before Congress, and you look at those titans of industry, if we'd have had John D. Rockefeller and Andrew Carnegie and J.P. Morgan at that thing, they wouldn't even have been able to touch the wealth that these fellows have today. So they're in charge. These are all data companies, folks. The most expensive thing in the world today, it's not gold, it's not oil, it's and not real estate, it's data. Data is the thing that runs everything. So remember that. But getting back to this pattern, is if you'll learn to do just really little simple things that work well, that's all you have to do. You don't have to read the news, and you don't have to listen to what the reports are and stuff. Just see how the market reacts to these things, and then you'll be able to get a slight advantage. And that's all you need, is a slight advantage to beat these folks, to beat these patterns. So, and you're not going to beat them all the time. If you're right about 62% of the time, or more sometimes, even at 20%, you can be profitable. Look at Tommy Hugard, Trader Tom. I mean, he's only right about 25% of the time, and he makes more money than everybody else combined. So just remember that these patterns, they give you a slight advantage, but you have to learn how they work. And it's simple to do. You just have to practice a little bit and prove it to yourself that it actually does work. And you don't have to worry about the fundamentals. I know it's fun to look at the earnings and stuff, if that's what you like to do. And we're going to have this huge gap today in Apple, and all you have to do is look at an Apple chart going back to when it started in 1982, and you're not going to see any gaps. So we know that gap is going to be filled. So those are another one. Remember, this is the last day of the month. This is the most one of the most positive days of the month. I believe is the last day of the month, and also the first day of the month. That's when the money comes in from these Ridex stuff, where people buy every month or on the first of the month. So, but all I'm saying is just look at that Dow Jones, folks. That Dow Jones is not a pretty chart. It really isn't. It's just not as bullish as, let's just look at it from, see if we can see where we were last week. And I think we can. Yes, we can. Let's get it up here. Yep, you'll be able to see it right here. This is where we were last Friday. And if you take a look at this, you'll see that we're trading below this price as we come in this morning, folks. And that's with all this bullish news. Now, in the Dow Jones, you do have some of these stocks are in the Dow Jones, but because they are they're not cap weighted, they're price weighted. That makes a big difference. So this Dow is just acting horrible. That's really what you're looking at. So you got to be careful up in this area. That's it. That's my 2 cents, and I'm sticking with it. Now, we will have Bill Meridian coming up here, and this guy has been very, very good to us here at TFNN, folks. We want to, treat the guy with respect, because when you can do it, it ain't bragging, and Bill has done it. He's talked about the bullishness in stocks, the bullishness in the gold market, and we're going to see what he has to have to tell us here. Maybe we'll even ask him a few questions if you have a question. 877-927-6648.
Commodities and currencies with Fibonacci retracement levels, possible trading setups and zones, and stops and targets for all recommendations included. Larry applies the principles he's developed over decades of trading while analyzing a variety of markets for subscribers. To see for yourself the types of videos, charts, and analysis that Larry provides for his subscribers, sign up for Fibonacci 24/7 today by visiting the front page of TFNN.com under the newsletter tab. You'll also gain instant access to Larry's archived subscriber webinar from earlier this year. New subscribers get a 30-day money-back guarantee, so you have nothing to risk. Sign up today. If you're a trader in the market looking to find the path that leads to maximizing profits while decreasing risk, then now is a great time to try out Dave White's daily trading service, The Path of Least Resistance. Through the use of options and equity trades, Dave advises his subscribers on a daily basis of the current market conditions and what possible trade setups are on the horizon. The Path of Least Resistance is published every trading morning, often with updates intraday when initiating trades or closing out positions. Dave White has advised his clients of some outstanding winning options and equity trades in recent months, and now is a great time to try it out for yourself. New subscribers to the Path of Least Resistance receive a 30-day money-back guarantee. See for yourself the types of options and equity trades that are available by signing up for the Path of Least Resistance today by visiting the front page of TFNN.com and selecting the newsletter tab. Sign up today. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, Butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, I believe we have Bill Meridian on the line. Bill, are you there? Oops, thought we had Bill call in. Shut the front door and raise the rent. Let me double check. Have him call in on Skype. Just give me a second, folks. A little technical difficulty, and we'll get this, and we'll call this. Hello? Okay, we'll get this started here, hopefully. Anyway, what he's looking for. Bill, are you there?
I sure am.
Hey, good talking to you, my friend. I started here with the 2020 forecast. I've already given you your introduction and stuff. You're looking for bonds are at a low. You say the S&P is rally to moderate. And the interesting one is gold to correct in August. Wow, this is good. You want to go ahead and start, Bill?
Yeah, we're on, Paige, first of all, you've gone over the announcements.
Yes, sir. I sure did. About the cycles and everything. We did that, yes.
2020, this is all very short term, of course. Slide number 4, I think, says, here is all you need to know. And this is the MSCI World Total Return. That's the light blue line, which hasn't moved yet. And there's the global real M1. So this is global. And that is the increase in money supply up in the upper right-hand peak of the graph where it says % year over year.
Wow.
And this is all this liquidity being injected into the system, which is really, I think, unnecessary and exactly the wrong thing to do due to the COVID crisis. And that blue line tends to follow, the light blue line follows the dark blue line. So this is why I keep, somebody called it the everything rally. And as my old friend Ian Notley used to say, if everything goes up together, everything comes down together. And so this is why you shouldn't go short. And this is why a lot of the normal rules of stock market forecasting need to get thrown out the window. There's just too much money around, and we're going to prove that in the next slide. Here you have, here's what happens when too much money is around. When you run out of assets to buy, it spills over into other areas. And this is an unopened Super Mario Brothers video game sold for $114,000, a new world record for a video game. It is special because it has a cardboard shop display hang tab. So that's what happens when you have too much money. And the next one.
I'm sorry, Bill, but I can't believe that. Go ahead.
Well, the next one is a Mike Trout baseball card, bid up to $1.2 million already with 3 weeks to go on the bidding. So this is how this manifests. I mean, you can't print all that money without creating inflation somewhere. It just happens not to be in the items that comprise the CPI. So anyway, I want to start off with bonds because I think bonds are a good one. First of all, August has been the strongest month to hold bonds. We'll see that in the next slide. The monthly cycle points up. The monthly histogram below depicts the August strength. Bonds have been up 73.7% of the time for an average gain of 0.91% and an expected return of 0.67%. These numbers are the highest of any of the 12 months. And the July momentum is likely to propel notes higher in August. And if July has been down, then August has been up in 9 of 16 cases. If July has been up, as it was last month, then August has been up in 19 of 22 cases. So if you go to the next slide, you'll see the expected return from 1983 through last year, and you'll note August is the highest. So not only is August the highest, but that's a static cycle in that it does not change very much. If you go to the next slide, there's the dynamic cycle, and you'll notice price, the heavy black line, has bottomed before the cycle. Now the cycle, 2 out of 3 of the cycles have been accurate in the last year. And you'll note that it bottoms probably right now, July 31st as we're speaking. So it looks like there's just so much money. As we know, bonds and stocks usually have a bit of an inverse relationship, but not anymore. That's why I say most of the rules get thrown out when the money supply becomes so excessive. So that's one change. I put some money into bonds. I didn't have any, because why would you put money into bonds when stocks are rallying so strongly? And the next slide is kind of interesting. This is the fallout for the riots. This is the daily asking rent per square foot. And look at San Francisco. So this was in an institutional report that I wrote. The minute I saw these riots getting out of control in the Northwest, I said, sell your real estate, because the city fathers aren't making any efforts to rectify the situation. So that is rentals. Look at New York. I mean, when was the last time rents declined in New York? I guess it was just after I left New York. I think it was it was 1990, 91, 92, in that time period. And so can we go to the next slide?
By the way, Bill, are you back in Austria now?
No, I'm not going back until October.
Okay, good. All right, there we go. We'll talk about the top 5 stocks.
The weighting, now we're at tech weighting.
Yes.
And the weighting of the top 5 stocks has increased by 5% in the last 6 months. If you add the market cap of Apple, Amazon, Microsoft, and Google, you're not even including Netflix. Really isn't a technology stock. And the number exceeds Japan's entire stock market. In other words, these 4 stocks alone, their market cap is enough to create the world's 3rd biggest stock market behind the USA and China. And for the first time since 1979, only 5 stocks account for more than 20% of the S&P's market cap, because the large stocks are dominating the index so much right now. The index itself can show a gain even with most of the stocks are declining. So I'm saying this because there have been a lot of messages running around that most stocks are, I think they're below, I forget which moving average, but there are very few stocks carrying the indices higher. But that all that needs to happen is for these stocks to be strong, and it will carry the whole index higher. So I don't think the lagging breadth, the fact that most stocks aren't keeping up with these stocks, I don't think that's a big deal. I mean, how can you compare what's going on at Apple with what's going on at Kellogg or Northern Southern Railroad or some bank? So,
wow, that's
it was, and I put in here, as I recall, it was the steel stocks that did this in the 70s. In the 60s, it was the steel stocks. In the 70s, the energy sector. And in the 90s, of course, it was technology again. So the next graph sort of makes this is it graphically. That's the big tech weighting. Technology is now a greater weight than it was at the 2000 bubble top.
wow. Bill, we have to pay a few bills. Could you stay with us, please? This is really interesting. We'll be right back, folks. Bill Meridian, Cycles Research.
The gold market has taken off topside in a large way in 2020. If you want to take advantage of this sector, now is the time to subscribe to my gold report. The gold report took profits in 4 of its equities in the gold portfolio in the first week of January for a combined profit of 99.2%, with 2 positions left in the portfolio that have a profit of 67.5% as of January 7th. The gold report is a comprehensive look at the metals sector as well as the markets that move gold, which is the currency and bond markets. New subscribers get a 30-day money-back guarantee, so you have nothing to lose. Every Monday morning, I publish the gold report with coverage of gold, silver, bonds, the XAU, HUI, GDX, as well as more than 30 different mining equities. To see for yourself the types of profitable trades that are recommended within the gold report, sign up now by visiting TFNN.com. Don't miss out on the next great gold trade. Sign up today.
Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den. The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of the TFNN shows, plus see all of the charts as they happen live and have access to archives of all of those charts. You can test drive the Tiger's Den absolutely free for 30 days and greatly enrich your knowledge of these markets and how to make your money work for you. Details on the Tiger's Den are on the front page of TFNN.com.
TFNN has launched our brand new website. You can still visit us at the same TFNN.com URL, but when you do, you'll see a new and improved homepage with a much simpler navigation, whether you're watching Tiger TV live in high definition or just accessing your newsletter subscriptions. We even have new pricing in 6 months and yearly options. Check out the new TFNN.com now and experience all the upgrades. TFNN.com, educating investors.
The Bull Bear Trading Hour with Tom and Tommy O'Brien. Next.
Okay, we're back, folks. We're talking with Bill Meridian, Cycles Research, and we're on page 13 with the monthly S&P cycles, Bill.
Yeah, this is the long-term monthly cycle. This is extracted from data, the cycles that are individually tested for profitability, and so it differs very much from other cycle software that I've used. But we're still at a bull market. This doesn't peak. Well, first of all, you'll notice it points up right here, and that line, the reaction of real price to that line is modified by sentiment and momentum. In other words, if this cycle turns up and the market is extremely oversold and sentiment is very bearish, you'll get a greater percentage gain than you will if those conditions do not exist. In other words, if the market is extended and sentiment is very bullish, this cycle turns up, you don't get the same percentage change that you would get if the reverse condition existed. So it's modified by real world factors. So that points up. And Larry, if you go down to slide 14, now these are the 1, 4, and 10-year cycles. I plotted them individually. The 1-year cycle is the red one, the average cycle of the year, the seasonal cycle. The 4-year cycle is attributed to the election cycle because it bottoms every 4 years. But this cycle existed prior to the establishment of the Federal Reserve in 1913, and it exists in countries where they have a 4-year election cycle, a 6-year election cycle, or no elections at all. So there's simply a 4-year cycle. And of course, the 10-year cycle, the green one, we're in the most bearish phase of the 10-year cycle, and that is years ending in 0, which is why it's trending down. But I think we already went through that in February, March. So I wouldn't pay too much attention to the green cycle. So as you can see, the point I'm making here is in Q4, look at that the 10-year cycle actually bottoms in October, and the other two cycles are already pointing up. So I think it's going to be a strong fourth quarter. I'm not very concerned about the market breaking down here, despite, if you go to the next slide, I'll point out some of the technical conditions. Now, the AAII is a poll of individual investors. It dropped to 20.2% bulls. It was 26 or 28 a few weeks ago, which still isn't high. And if you also, I'm trying to think, is it the Conference Board? They have a survey in which they ask consumers what they think of the stock market. Well, they all think it'll be down in a year from now. So that's a poll which is not based on actual trading. And it is the most amateur side of the investment spectrum. But corporate insiders were heavy buyers in March. They have decreased their buying, and they've done a bit of selling. The buying is very heavy in the energy sector, so these guys know that their companies aren't going to disappear. So they're buying now that the prices they were low in March. And the latest survey of active investment managers from the NAAIM shows that the average manager is 97% exposed to stocks. Now that number has been very tiny at market lows. It could be 10 or 20%. Even the most bearish manager is net long. And also I threw in the wrong place, the equity put call ratio, 50-day moving average is at its lowest level in nearly 2 decades. So in other words, the conditions that the market is facing are not as rosy as they were. Sentiment has now mostly improved as far as the professionals go, but not as far as the amateurs go. And all of the numbers have moderated now. It's not extreme enough to call a top, but it certainly isn't a low either. So I just think that the market is going to rally, is going to moderate, and I'm just trying to get a fix on the S&P is only up 6.3 at the moment, and I think next week is the period of end of month strength for July going into August. However, short-term cycles look bearish, so I think you're going to see another week like we just had, a very erratic, choppy week that I think at best will be flat. And this is on the next slide, which is 16. You'll note the departure analysis, the red line at the bottom is a momentum indicator. And note that it is oversold. It is as oversold as it was in 2019 and 2016 and 2012. And this is the monthly S&P. So if you look at this, just look at this and the 2 cycles I just showed you, the 1, 4, 10, and the S&P monthly cycle. If you put that together, I don't think there's that much downside risk. Wow. So, and really, I just talked to, since my clients are institutions, I just talked to a fund manager yesterday, and, which stocks do you think will do best? I said, and their earnings after the bell, and I said, well, Amazon, Facebook, and Apple, leaving out Google and Netflix. And the dilemma they face, which is worse than the one I faced in the 90s, is that if you hold on to them and the top comes in, it's like an anchor. Like if you throw it overboard, then it's hard to get it up and get moving again. So if you sell these stocks too soon, you are going to kill your performance. And if you sell them too late, so the whole key, there's a very smart fund manager. The whole key is if you're a fund manager, when do I sell these stocks? The big market cap, the biggest market cap stocks that we just looked at, because they have to own them. It's a question whether they own more than the market weighting or less. So this is the same thing. Back in the old days when I was in Abu Dhabi, I talked to Phil Roth, who was the strategist at Morgan Stanley, and said, Phil, he said, looking back, Bill, he said, the whole you could have positive performance by doing 2 simple things: overweighting technology in the 90s and then underweighting it 2000 to 2002. That's all you had to do, which is one of the reasons I left that whole world, because I got tired of sitting around listening to people talk about things that have no relationship to the market at all, and just are unable to see these things. And I was the guy who kept us overweighted in technology. And so anyway, let's move on to 17.
Yeah, this is gold. Yes, this is a lot of interest here, my friend.
This is the strongest seasonal period. You can see where I drew the arrow. June, the expected return is up slightly. July, it gets better. August, better. And September, even better. The numbers are that August is up 60% of the time and September 61% of the time. But the percentage increase in price is much higher in September than in any other month. So when you multiply 0.61 times whatever that return is, I guess it must be 1.6. So the expected return comes out to 1.0. So it's a combination of the likelihood it'll be up and the amount it will be up. So you can see we're in the strongest seasonal period. So let's go down now to the dynamic cycles, and you see the weekly on top and the monthly on the bottom, and they're both peaking and turning down. The weekly I don't pay too much attention to because the weekly cycle can easily be dominated by
let's pay
go
a few
sell some
bills
gold.
here.
Yeah.
You okay.
Back in the day, I joined Hotel California in 2006, and like many of you, was drawn in by, as well as,
whatever you think about, you bring about. Whatever you focus on grows.
You see, I believe that everything in life happens for us, not to us. And Tom ignited the fire within me to want to learn how to master the markets. So how did I go from knowing nothing about technical analysis to becoming the #1 market timer for the S&P 500 in 2018 and the #2 market timer in 2019? Simply put, I hired coaches with a proven track record, which led me to a whole new set of tools that I created to interpret the message of buyers and sellers. I would love the opportunity to teach you this award-winning set of tools and to help you improve your market timing. You can test drive my newsletter service, Mastering Probabilities, for the next 30 days with no risk to you. Plus, you'll gain access to archive workshops that'll take you step by step through my system. Sign up today by going to the homepage of TFNN.com and selecting Mastering Probability in the newsletter tab. Bam!
If you haven't checked out the newsletters page of TFNN.com, what are you waiting for? All of the TFNN newsletters are informative, up-to-date, affordable, and a must-have for every trader looking to gain a competitive informational edge in today's markets. TFNN newsletters cover every aspect of the markets to offer you the very latest in market news. Plus, new subscribers get to test drive our newsletters risk-free for 30 days. From all aspects of the markets, including stocks, bonds, metals, commodities, and tech, there's a newsletter to fit your needs exclusively from TFNN. Stay informed each day you trade and get that competitive edge that will help you stay ahead of the game. Visit our newsletters page by going to TFNN.com and click the newsletters button near the top of the page. TFNN.com, educating investors.
With markets trading with extreme volatility and peaks and troughs everywhere, regardless of what you're looking at in the markets, this is a great time to see the type of analysis Basil Chapman delivers for his subscribers every market day with the Opening Call newsletter. Basil has been analyzing markets, providing his take for subscribers to his trading services since 1984. Every morning, Basil publishes an update for his subscribers, along with weekend and evening updates when warranted. The Opening Call provides traders a daily market overview with regard to the direction of the key indices, selective stocks, and commodities, along with specific recommendations, including stops and targets. You also gain instant access to Basil's subscriber webinar archive from earlier this year, a dark cloud cover, and essential market analysis. Ride the Chapman wave today by signing up for the Opening Call newsletter on the front page of TFNN.com under the newsletter tab. New subscribers get a 30-day money-back guarantee, so you have nothing to risk. Sign up today.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, with Bill Meridian talking about these cycles that we're seeing in gold right now, Bill?
Yeah, and the only, what we have here is a rare, it's Jupiter is 300 degrees from Neptune, which is called a sextile. If it's 360 degrees apart, they call them sextiles. Happens about every 13 years. Hard aspects usually drive the gold price up. This is a soft aspect. It usually knocks gold prices down. All 7 such angles since 1969 have had that effect. So it's 7 out of 7. So if you go to the next slide, there it is. You see I drew the little black arrow?
Yeah, wow.
So, and you see gold is very extended. Now, Larry, if this were happening, the histogram of the months, if this were happening during a weak month, I would be mortgaging the house to go short gold. But it's, as you see, the seasonality is just swung into its most favorable period. So it is going to blunt the effect of this. And if you go down one more, I just want to show you, so I know we're running short on time. That is the extended gold cycle. Note it doesn't top until November. So that little decline there in August looks like a point in which to add on to your gold holdings, which is what I think. And if you go to the last slide, this now counts this breakout to 2250. And if gold is going to fall, this is like that old analogy of the guy who wants to jump out the window, but he lives on the first floor. Where is it going to fall to? And at the most, it could fall to 1750, but probably, would retrace half of that. So half of that distance from 1750 up to would be about 1850 or so. And the timing would be very tricky, but I would think that would have to start declining in the next week sometime, because all these cycles are peaking right now. So this is a tough call because it is occurring. It is a short-term down move. It lasts about X number of days, but in an upswing. And if you remember when I came on, I pointed out that Jupiter conjunct Pluto was bullish for stocks, and it lasts 30 days. And look at July. That effect is now, but that's how these things work.
Hey, thanks. And by the way, Bill,
Yeah, sure.
They're all tough. I've never found an easy one yet.
Okay.
Hey, thanks for joining us, buddy, and be safe.
My pleasure, Larry. Bye-bye.
Bill Meridian, Cycles Research. See you Monday, folks.